I've worked with thousands of retired clients during my 25 years as a financial planner. As you can imagine, I've heard a lot of stories, but unfortunately, I've also heard a lot of regrets from many of my clients. So today, I've compiled a list of my past and current clients' biggest investing regrets so you can avoid making the same mistakes they did. Let's start with one of my clients we'll call Chris. He was very transparent with his biggest regret, overconfidence. This is what he wrote. I used to believe that intelligence alone could beat the market. I used to think that if I read enough, researched enough, and stayed plugged into enough financial news, I could outsmart everyone else. I thought the market rewarded cleverness. What I learned painfully is that the market rewards behavior. I made trades based on overconfidence. I bought into narratives that a lot of financial gurus out there threw around. I allowed that illusion of their so-called knowledge to push me into decisions that felt smart, but were not actually strategic. And those decisions taught me a lesson I still hold on to today. I really like what he said here, because a lot of self-proclaimed experts on the internet push this idea that the market is a puzzle to solve. But it's not. It's a system to participate in. And if you stop trying to outsmart the system and instead start aligning with it, you can begin to make positive changes to your financial situation. Now, by being a viewer of our YouTube content, one of the benefits you can take advantage of is requesting a free video review from us on your unique financial situation. Stay till the end of the video to learn more. Here's another regret I hear a lot, and honestly, it's probably the most dangerous trap in investing: trying to time the market. Here's what my client Amber wrote. Trying to time the market was a big mistake. In the moment, it always felt logical. In fact, it even felt like the responsible thing to do, because it felt like I was managing risk. But every attempt I made to jump in and out of the market based on predictions, fear, or excitement ended up backfiring. It felt reasonable to wait out volatility or chase momentum in the moment, but the irony is that by trying to avoid losses, it often caused me to lose gains. Now that last piece she said there is very critical. The biggest market gains often cluster into a handful of critical days, and missing even a few of them has a staggering impact on long-term returns. Look at this chart. If you missed just the 5 best days of the stock market performance between 1980 and 2025, you would have lost out on almost $650,000 compared to if you had just ridden out the bumps in the road. Staying disciplined through volatility proves far more profitable than trying to anticipate it. Now this ties into the next regret for my client Kevin. Now he admits that he recognized the importance of staying invested during downturns, but listen to how fear overpowered his logical side. I made emotional mistakes during market downturns. Even after learning the importance of staying invested, I was not immune to fear. There were times when the market dropped sharply and my mind shifted into preservation mode. I would tell myself, let me just wait until things calm down, not realizing that things calm down only after the market recovery has already started. Selling during downturns was one of the most expensive mistakes I made. So I find this interesting because this regret resonates with a lot of people. It happens because our brains are wired to avoid pain. And no matter how intelligent we are or how aware we are of the damage it causes, that hardwiring is hard to overcome. Now there's 2 things that can help a lot of people with this. First is creating a better structure in your portfolio. If you learn to build a portfolio that's aligned with your actual risk tolerance, not your idealized version of it, staying invested can become easier. The second thing is bringing in someone else, like a financial advisor, to help manage your money. Aside from the many other benefits of working with an advisor, and you can watch my colleague Jared line those out in this video, you're putting an extra layer between you and your money. Think of it like this. You see the market sliding. You start to worry, so you give your advisor a call to potentially move that money around to cut your losses. But your advisor is able to provide reassurance that you don't need to worry. And within a couple of days, the market has rebounded back to where it was before. Without the advisor as your buffer, if you had moved that money out of the market and waited just a bit too long to put it back in, you would have missed out on a good chunk of that upside. That quick call with your advisor can be enough to override the pain hardwiring in your brain. That hardwiring can go the other way too, and we can also get carried away with trying to chase excitement. Listen to what Carrie told me. It was one of the most humbling mistakes I made. There were times when I let hype, momentum, or popular trends influence my decisions. I would see a company or sector skyrocketing and feel the fear of missing out. And I would convince myself that this time it was different, that the rules didn't apply, and that the trend would continue forever. It never worked. Maybe you've experienced this too. Chasing excitement does not feel like gambling in the moment, but it has all the same characteristics of it. Wealthy investors do not become wealthy because they chase excitement. Instead, they become wealthy because they chase consistency. And having that same outlook for yourself is key. Now, there's a lot of things that can slowly eat away at your portfolio over time. And one of the regrets I hear from my retired clients is underestimating the impact of fees. Listen to what John said. I used to not pay attention to expense ratios, advisory fees, or fund costs. I assumed since they were all such small percentages that they didn't matter. But over decades, I started to realize those small percentages become massive. That was a wake-up call for me. To really put this in perspective, let's compare two hypothetical investors with identical portfolios, identical contributions, and identical returns. The only difference is one paid an extra 1% in fees. Just that 1% difference ends up being hundreds of thousands of dollars at retirement. That's a huge number, right? Well, it's because fees do not just reduce your returns, they also erode the acceleration of compounding. Over time, that little 1% difference widens the gap more and more and more because that compounding effect is still being stifled while the lower fee portfolio benefits from that additional money compounding over years and years. Therefore, what I tell you is that it's very important to evaluate every investment through the lens of long-term cost. Keeping fees low doesn't mean you're being cheap, it means you're being strategic. Now, speaking of long-term costs, another common regret I hear is how many retirees never treated taxes as part of their investment strategy. Here's what my client Earl wrote. Early on, I made decisions based solely on returns without considering tax impact. I would sell assets too quickly, triggering short-term capital gains. I underutilized tax advantage accounts like Roth IRAs or my employer's retirement plans. I missed opportunities for tax loss harvesting. Once I realized how much taxes can actually affect my long-term compounding, I began seeing investing in a different light. You see, to build a successful investment strategy, taxes cannot be an afterthought. They must be a core part of long-term planning. Wealth doesn't come simply from the returns you earn. It comes from the returns you keep. And reducing the amount of taxes that eat away at your returns can help build and safeguard that wealth. Now, something that can really complicate things from a tax perspective is overcomplicating your portfolio. I've had a lot of clients who, before they started working with me, took a DIY approach to investing over the years. And while there's absolutely nothing wrong with doing things yourself, the danger is that it can be very easy to get in over your head. As my client David pointed out, at one point in my life, I made the mistake of overcomplicating things. I owned way too many funds, too many accounts, and was trying to do too many strategies layered on top of each other. I was able to build this idea of sophistication in my mind, but truthfully, what happened was I got lost. My portfolio became fragmented and very inefficient. When I took a step back and finally started to simplify my portfolio, really pinpointing my focus on a strong, diversified core, it became much easier. Easier to manage, easier to rebalance, and quite frankly, easier to stay committed to. Simplicity is not a lack of intelligence. Oftentimes in investing, simplicity is the highest form of clarity. And clarity is what keeps people invested during challenging moments. Now, if we're going to talk about investing, we also have to talk about liquidity. I've seen a lot of people who are excellent savers. They make large, consistent contributions to their 401ks. They max out their Roth contributions every year. They have a solid portfolio invested in the market. But just like overspending can create financial problems, so can oversaving. And this happens when savers don't maintain liquidity by putting money into retirement accounts they can't touch until after they retire. My clients Deborah and Bob fit that description very well. They were very disciplined savers, very financially savvy, but they fell into this trap. Here's what they wrote. We realized too late that we had been ignoring liquidity. We were so focused on long-term growth that we did not build a strong enough foundation of accessible cash. When some unexpected expenses hit, we had to make decisions that disrupted our long-term plan. Now, since they were disciplined savers, they were eventually able to course correct and are now living a wonderful retirement. But imagine if they hadn't been disciplined savers. Imagine if they routinely spent beyond their means and didn't put aside any cash for an emergency. Wealthy individuals understand the importance of liquidity because it manages risk. Cash is not a wasted asset in that sense. It's a buffer that can prevent difficult decisions from having to be made. It's a tool that keeps your long-term plan intact. By building a liquidity layer into your portfolio, you've aligned yourself with the unpredictability of real life. The last regret I see is a bit more abstract, but out of every regret we've talked about in this video, it's by far the most impactful. failing to align your portfolio with long-term purpose. I've had countless clients tell me, I invested because I knew I should, but I didn't fully understand what I was investing for. When you do not have clarity on your purpose, it's easy to drift, to react emotionally, or to lose discipline. But when your investments are tied to goals, freedom, family, impact, and consistency, you begin treating investing as a form of stewardship. Every decision becomes intentional, and that intentionality changes your entire financial life. And we're here to help you build that intentionality. Click the link in the description or scan the QR code on screen to receive a free video review from us on your current financial situation. Let's ensure your future financial outlook is a good one. Thanks for watching.